Welcome to TSET. As part of the series in Indian economy, we started discussing about public finance, and the most important part of it is that's what budget has been already discussed in previous sessions. And then we already had discussion over taxation. What is tax? The difference between cess and surcharge, and then tax and the terms related to taxation. So now let's continue our discussion with the second part of taxation. And in this particular session, we'll just try to understand the terms related to certain important taxes. Though it's not necessary that whatever the tax I would be discussing in this session is been as of now levied, but I do really think it is really worthy knowing about the meaning and the purpose of this taxation. Let's start with the first term, Pigovian tax. Pigovian is the name of an economist who has proposed this tax. So when it comes to the word Pigovian tax is defined as the tax levied on the negative externalities. So what is the meaning of negative externality? So when I say externality refers to the impact of a person's action on the bystander. So this is how we define an externality. Let's say one person, let's say someone is producing thermal power. There is a person whose business is to produce power. It's a thermal power. So this man producing thermal power results in pollution. I mean, his actions results in a certain environmental, certain consequence upon the environment that's going to result in pollution. Of course, this man has no intention to pollute the environment, but his actions might result in pollution, and that's simply the cost that every person in society has to pay. So this is the reason I happen to define externality is the impact of one person's action on the bystander. Similarly, certain actions of some people or certain economic transactions would have certain positive consequences on the society. Let's say people imparting education. Isn't it? You are paying money and the institution is imparting education, but as a result, the society at large is going to benefit with large number of educated and skilled pool of labor, isn't it? So that's how certain transaction would have a positive impact on the society. So there would be certain positive consequences and negative consequences for every economic transaction or for every man's action, for any action result of a man, isn't it? And the tax that's been proposed upon such negative externalities is what we call Pigovian tax. Let's say one fine example is carbon tax. As of now, we don't have this tax by name carbon tax. In some 4 or 5 years back, there used to be a tax by name carbon tax in Australia. This carbon tax is a tax levied upon the carbon footprint of the company. So carbon footprint has been the amount of carbon dioxide that is being released by the various companies in a given span of time. The number of tons of carbon dioxide that's been emitted. Similarly, as in India we have something very similar, but not exactly a carbon tax or what we call it as. So we have something called clean energy cess. So out of every 1 ton of coal mined in this country, whether it's for a captive purpose or commercial purpose, the companies has to pay approximately 200 rupees to the government of India, and that's what we call clean energy cess. Isn't it? So Pigovian tax is a tax levied on the negative externalities. And the second tax is Tobin tax. Tobin again is named after a person, that's James Tobin. Tobin tax is a tax levied upon the forex or simply sale and purchase of foreign currency. So whenever you simply convert your domestic currency into foreign currency or foreign currency into domestic currency, a tax that's been proposed is what is called Tobin tax. So most of you would be thinking, how does it really matter and why do people levy taxes? So if I'm converting my rupee into dollar or dollar into rupee. So the very basic purpose of simply coming with this idea of taxation at the time of selling or buying a foreign currency is to simply keep the rupee stable or simply to ensure the speculation in foreign currency transactions would be under control. Let's say at times when rupee is steeply depreciating because people, lot many investors in this country are leaving, let's say the foreign institutional investor 𝗹𝗶𝘁 is simply leaving this country. As a result, dollar is steeply appreciating. So there could be many people in the market who might anticipate dollar might further appreciate, and let's simply accumulate more and more dollars and take the advantage by simply selling these dollars at a higher price. So in order to curb the practice of speculation in such kind of forex trade, this man has come up with an idea, why don't you tax simply those people whoever buys it and whoever sells the currency. So in order to avoid this simply practice of speculation, this has been a tax proposed. Though we have never imposed such kind of tax, but I just want you to know, to be aware of the fact what exactly is the meaning of the Tobin tax. The third comes the minimum alternate tax, and you might also have come across this term called alternate minimum tax. To a large extent, they happen to be similar. So when it comes to minimum alternate tax is a tax levied upon zero tax companies or book profits of a company. So what do you mean by this? Most of you might be having this confusion. What do you mean by zero tax companies? Okay, when the company is zero tax company, then why would government happen to levy a tax, or what do you mean by book profits? So my friends, when it comes to payment of taxes in this country, or simply running a company, so what exactly is the company, how to maintain the books, and how to report your transactions, everything in this country when it comes to running a organization or running a company should be in accordance with Indian Companies Act. So many of these organizations would be reporting some income, would also be paying dividend to their shareholders, and would report a large proportion of profits in their books. But when it comes to payment of taxes, ideally in India, the tax has to be paid in accordance with the Income Tax Act of 1961. So that's the basic reason the IT Act, as per the IT Act, the government might have given them some concessions or deductions. So because of various tax concessions available in the economy, because the government want to promote certain initiatives, so these companies, whichever has reported profits in the books and also share dividends to their shareholders, might not end up paying taxes. Because when it comes to payment of taxes, it should be in accordance with IT Act of 1961. Those companies, the tax levied upon those companies which reports which reports profits, but they are not ending up paying any tax to the government as per IT Act of 1961. So an alternate tax that they are expected to pay is generally what we refer as minimum alternate tax. So when say when we refer alternate minimum tax, AMT, this is MAT, and AMT simply does mean that's upon the individual families. Dividend distribution tax. So before going into dividend distribution tax, let me make it clear with the word dividend. So dividend is not exactly the profit made by the companies. So generally if an organization or any company reports a profit, all the profit is not equally shared among the shareholders. Because if a company whenever makes some profits keeps on distributing among shareholders, the company would never go for investing more and more money. Because if a company has a prospects of making more money by investing more money, then definitely any business person would simply plow back the profits back in the company. But at times when the company thinks there is no point in simply investing money, investing back the same profits made out of it, in such case, certain part of the profits is what the company might end up deciding to distribute to the shareholders. So the profit the company reports, part of the profits is retained by the company, maybe for the sake of expansion of the company, maybe for the sake of exploring new opportunities. Whenever the company thinks that it is not in a position or there is no point in simply investing back, because its ability to generate more returns out of the money invested is been significantly minimal, in such case the company ends up sharing certain part of profits to their shareholders, and that proportion of profit shared to the shareholders is what we call dividend. And at the time of distributing this dividend, there is a tax levied, what is called dividend distribution tax. Until 1920, 2021, this used to be taxed, at the time of company distributing it. But as of now, there's a change, is that though the tax is applicable, but the only change is that now the tax, now the DDT or simply the dividend distribution tax is taxable within the individual, the one whoever happens to report this dividend. So the other important tax that's is capital gains tax, very popularly referred as CGT. So this capital gains tax is further classified into short-term capital gains tax, short-term capital gains tax, short-term capital gains tax, and long-term capital gains tax. Short-term and long-term. So based upon the duration. So if this short-term and long-term happens to vary based upon the type of an asset. So if it is a physical asset, generally land, buildings, we happen to differentiate with a time period of 24 months. So imagine if a person happens to retain, if a person purchases an asset, and retains it for a span of more than 24 months. Just imagine if someone has purchased a land or a building, he retained it for a span of more than 24 months, made a sale out of it. If you buy it at 1 crore and sell it at 2 crores after 2-3 years, then whatever the gains made upon the capital invested, you are liable to pay a tax on it. So if the period exceeds more than 24 months, you are liable to pay long-term capital gains tax. If it is less than 24 months, you retain it for a span of less than 24 months, what is the tax you are liable to pay is what is called short-term capital gains. Similarly, when it comes to financial assets, like say shares or bonds, debentures, if you buy a share of a company, retain it for a span of more than 12 months and make some gains out of it, then you are liable to pay long-term capital gains tax. If you retain it for a span of less than 12 months and sell it and make money, you are liable to pay short-term capital gains tax. So it's based upon the type of asset, the duration happens to vary, but capital gains simply does mean the gains made upon the capital invested. So whatever the gains you report, you are liable to pay a tax, and that's what we call as a capital gains tax. So having seen some important taxes, I don't really think that beyond these things you need to know more and more about taxes, though there are a lot number of taxes that you will be coming across, but I do really think what serves for your examination purpose for your examination is these taxes. So before going into the two most important taxes that we have not discussed as part of until now is the VAT and GST. But before understanding the importance of VAT and GST, value added tax and GST, let me make it clear with respect to the two prominent problems related to indirect taxes and the reason. You could only appreciate VAT and GST only you've been aware of the fact what exactly is the problems related to indirect taxes in this country. There are two prominent problems related to indirect taxes in this country. The first and foremost problem is the cascading effect of taxes. What do you mean by cascading effect? Let's say if a product happens to undergo multiple stages. Imagine I happen to be the one who produces raw materials, some raw materials. I produce some 100 rupees worth raw materials, and this 100 worth raw materials has been sold to some a company which transforms this raw materials into some output. So in this case, I am just trying to imagine there is a sales tax levied, and this output whichever has been produced by the company, just imagine is again purchased by some other company to transform it. So this output ends up becoming an input to some other company. Similarly, this particular output, whatever has been produced by the company, if it turns to become an input to some other company, and that company transforms this particular raw materials into some output and again makes sale, and this is purchased by the distributor. This output is finally purchased by the distributor, and this distributor finally distributes to the retailers, and finally the retailer is the one who happened to sell it in the market. So if you look at it, ideally every product might happen to undergo multiple stages during production and during distribution. I mean there might be lot number of middlemen and there might be lot many transactions or lot many stages every product might happen to undergo. Imagine if the tax has been levied at each and every stage. The problem in good old days is that whenever the tax is computed upon the value of the good along with the tax that's been paid in the previous stages. And this problem is what we call cascading effect of taxes. I mean, whenever the tax has been computed, the tax is simply, or what forms the tax base, simply the value of commodity along with the taxes paid in the previous stages. The more is the number of stages the product happens to undergo, more is the tax burden upon the people, and that happens to be the very common problem referred as cascading effect of taxes. And the second most important problem related to indirect taxes is what we call lack of a common market. So, since I already made it clear in the previous session related taxation, in India, the central government has a right to levy taxes, state governments have a right to levy taxes, and even the local bodies also have a right to levy taxes like octroi duty, isn't it? So, that being the reason, it's not necessary whatever the state of Telangana levies or is the same tax rate that the state of AP, Andhra Pradesh would levy. That's the reason many times you've been aware of the fact the price of petrol, aviation turbine fuel or any petroleum related products so keeps varying from one state to other state. Similarly, the price of alcohol keeps varying because if it's only, imagine there is a product and the center is the only one or central government is the only one who is levying tax upon it. So, the entire country would have the same, the product would be traded at the same price across the country if only the center levies the taxes. But since states also have a right to levy particular amount, certain amount of tax, certain types of taxes, and these tax rates might vary from one state to other state. As a result, what happens? The price of a commodity in different markets of the country keeps varying, and that problem is what we generally refer as a lack of common market or lack of uniform market. So these are the two problems related to indirect taxes. Though we're not having we're not discussing about direct taxes because I think you would be able to figure it out. The very common problems related to direct taxes. So if we find some enough time, we will be discussing about it, but let's go ahead and try to figure out what exactly is the way we have overcome these two prominent problems related to indirect taxes. The first one is cascading effect. The second is simply the lack of common market. So VAT. So most of you might be thinking VAT is simply a new tax that people are expected to beyond all the taxes we are paying. No, VAT is simply a different type. It's a innovative method of computing tax. That's it. So, we are computing tax in a different way, and when it comes to VAT, we are simply computing the same tax in a different method, that's it. So, it's a methodology of taxation, but not an extra tax we are expected to pay beyond whatever the sales tax we are paying. So, you all know the fact that VAT has replaced sales tax somewhere in 2005. Simply, the central also has come with central VAT and then modified VAT, isn't it? So, no matter whatever is the tax, whether it's the center or state levies, it's replacement of certain existing taxes. And how is it replaced? Not only the terminology has been replaced, what has been replaced is the method of computing taxes. As I already discussed, when it comes to cascading effect of taxes, what's the very common problem? The tax, whenever the tax has been computed, the value of the product along with the tax paid in the previous stages end up becoming the tax base. So as a result, we are computing tax upon the tax paid in the previous stages. But when it comes to value added tax, it is a multi-stage tax or a multi-point tax. That means every time there is a change in hand, every time this particular product happens to go various stages, at every stage of transaction. During the various stages of production, during the stages of distribution, every time a product happens to undergo a particular stage, the tax is levied in proportion to the value addition. And I guess you remember the what exactly value addition. So value addition refers to simply the contribution of labor and capital during that particular stage. So the tax is only levied in proportion to the value added. So how would you compute the value added? Simply the price of output. We simply take the price of output minus the cost of intermediate consumption. So this is how we compute the value addition in that particular stage, and the tax is levied only in proportion to the value addition, but not upon the taxes paid in the previous stages. So as a result, the advantage is simply that since the product happens to go multiple stages, and every stage the tax is levied only in proportion to the value addition, the overall tax burden upon the product enormously decreases. When the overall tax burden upon the product decreases, one could easily imagine the benefits out of it. That is, when the overall tax burden reduces, the retail price of the product happens to reduce. So as a result, and you know the fact, when the prices of goods and services decreases, what happens to the consumption? It increases. So that's how the government of India has overcome the problem of cascading effect by simply replacing with a different method of computing tax. That's what we call value added tax. But the other problem still persists, because VAT has replaced sales tax, and in every state the VAT rate again happens to vary from one particular state to other state, and henceforth the government has come up with solving this problem, that is lack of common market, by introducing a new and innovative tax. That's what's called GST. So how would you define GST? GST simply does mean goods and service tax. So we know before the GST has been enrolled in 2017, somewhere in the month of June. So what happens? There are taxes levied by the center, taxes levied by the state, and there is and upon the goods, the center and states levying certain kind of taxes, and then upon services you have a separate tax levied, and the taxes keep varying from one category of goods to other category of goods, and then to services, isn't it? And there are multiple taxes across the nation. So the government, at the end of the day, in order to overcome or to create one nation, one market and one tax rate, has come with one comprehensive indirect tax, and that's what we call GST. So GST is a comprehensive indirect tax that subsumes a lot many indirect taxes levied by both the center and states. And it since it has subsumed, it does mean that so all these taxes that we will be listing out right now has become part of GST. And since 2017, all these indirect tax has been subsumed into one tax, and upon all these category of goods and services, whatever been under the purview of GST, we have the component of central GST and state GST levied in equal proportion. So does mean if a commodity is levied a tax of 16%, does mean around 8% is the tax levied by the center, 8% is the central component and 8% happens to the state component. So that's how we happen to bring in one tax rate across the country to overcome this problem of lack of uniform market. So GST could be defined as GST could be defined as a finest refinement of VAT. So like VAT, GST is again a multi-stage tax. It is also computed in proportion to the value addition at each and every stage. And the other advantage beyond VAT, or the difference between the major difference between VAT and GST, it happens to subsume almost all the taxes except very few. And there's a uniform tax rate across the country, and that's how GST happens to be a finest reform. And in fact, you could say it is one of the greatest tax reform that we have to bring in post independence when it comes to indirect taxes. So let's look at what are the taxes that has been subsumed under the GST regime. So when it comes to taxes currently levied and collected by the center, the central excise duty, duties of excise medicine and toilet preparations, and then additional duties of excise on textiles and textile products. So these are the taxes from the center. Additional duties of customs, special additional duty of and then service tax. Central surcharge says so far as the related purchase tax. Of course, not exactly the entire session surcharge has been subsumed. And then tax on lotteries, betting, gambling. When it comes to state taxes, we have the state VAT. So, previous sales tax has been replaced by state VAT, luxury tax, entry tax of all forms. These are certain taxes. So, it's not necessary to simply mug up all the taxes, but I just want you to simply remember the fact that many of these taxes has been subsumed, and we only have one comprehensive indirect tax as of now that is being levied by both the center and the states. And who really in reality formulate this particular, I mean, how is it about tax rates levied? These in the recent past we have this debate going on. Some of the states are opposing the tax upon certain category of goods and services, isn't it? Who really legislate upon the matters related to taxation when it comes to GST? So in India, when it comes to GST, we have something called GST Council. GST Council. So it's not only the central government or the state governments alone happen to decide upon the matters related to GST. It is the GST Council, wherein there is a participation by the center and all the states. So that and this GST Council is the one which happens to take the decisions related to all the matters related to taxation, whether to bring a certain amount of a certain category of goods into the purview of GST or keep them out of the purview of GST, change the tax rates, exempt some category of goods. Everything with respect to GST as of now India is decided by GST Council. And how is the decisions made in GST Council? If you look at when this comes to GST Council, the center has a representation, and also all the states in the country along do have a representation along with the union territories that has legislatures. Around 1/3 of the voting rights is with the center and 2/3 of the voting rights is with the states. And any decisions in general has to be any decisions taken is with the minimum support of or consent of 3/4. But most of the time you might have seen majority of the decisions taken in the GST Council with 100% consensus. 100% consensus does mean almost everyone whoever happened to be part of GST Council happened to accept it. But ideally this is how the voting mechanism is. So if you have noticed the fact 3/4 of majority is required to make any changes, and neither the center nor the states alone could simply pass on any changes or any amendments with respect to GST without the support of other organizations of other organ of the government. So the center needs the state's consent, and states many a times also require center without taking the consent of the center. They cannot alone make any major changes in the GST. So that's how there's been a balance between the voting rights between the center and states. Neither the center nor the states alone have the absolute rights to alter the GST or make any drastic changes with respect to GST. So as of now, once the GST has been enrolled, this is how the decisions are made with respect to any changes related to GST. Maybe bringing some items, as you already aware of the fact, petroleum products are out of the purview of GST. Alcohol are out of the purview of GST. So whether to bring in or whether to exempt them, or simply the case of what exactly the tax rate of certain category of goods and services, everything as of now is more or less decided by the GST Council. That's what's the purpose of this council. Now let's go ahead and look at certain other important terms related to taxation. So the very common problem that these days we happen to often come across is the increasing size of black money. Many countries, and no matter whatever is the state of well-being or economic well-being of person, everyone in this country knows about Swiss banking. Everyone in the country knows about Panama, isn't it, the Panama papers. So what exactly is this, Panama papers, what exactly they mean? So take the case of Mauritius. So until last 4 or 5 years, we happen to have, India used to attract a large proportion of foreign investments from Mauritius. Why is it so? From such a small country, India happened to attract a very large proportion of foreign investments. What is the secret that lies with this particular country, isn't it? So take the case of Singapore city. There are not many such places where Cayman Islands, where you have come across this kind of one common pattern observed among these countries, and they are generally referred as tax havens. So when it comes to tax haven refers to those nations which have very minimal tax rates or near zero tax rates. Minimal tax rates or near zero tax rates. You might have come across a lot more. Take the case of the city of Dubai, isn't it? In fact, when it comes to personal income tax, it's literally zero. So there will be an ample number of such countries where the tax rates are very low or near zero. So such nations are generally referred as tax havens. So generally, what do you think is the problem with the tax haven? So now let's say, imagine most of you might have avoided an agreement, something called double taxation avoidance agreement. Double taxation avoidance agreement. So in fact, this is a self-explanatory. Double taxation avoidance agreement. So it does mean, so avoiding taxation more than once. So this is an agreement simply between the nations with respect to avoiding or reducing the tax burden both at the source and also at the destination. Let's say, imagine there are two nations A and B. There are two nations A and B. An investor from A happened to invest money in this nation B. An investor from A invests money in the nation B. And in the B, if he reports a profit, okay, and upon the profits reported, this gentleman is or this company is liable to pay taxes. This company is liable to pay taxes, isn't it? In the country B, this company wherever the profits originate at the source. And if this company takes the profits back to their parent country, okay, and at the destination, I mean to say the place where the profits reaches, they are again liable to pay taxes on it. And that's what's the reason the same income generated in B is also being taxed at A. So same income is being levied tax multiple times. So that would, okay, such kind of taxation upon the same income multiple times literally discourages investors flow, okay, moving money from one particular country to other country, and henceforth nations come together to avoid payment of taxes or living taxes both at the source and the destination. Now imagine a problem, okay, take the case of country like India. If it happens to make a double taxation avoidance agreement with a country like Mauritius, which is a tax haven, but whereas we don't have any similar kind of agreement with the United States of America. So what do you think will be the problem? Okay, since we don't have any tax agreement or tax concessional agreement with United States of America, these Americans, in order to take the advantage between the Mauritius and India, they happen to route their investments through Mauritius, and as a result, India indirectly ends up becoming an indirect tax haven. So this is how many nations and many investors do take the advantage of simply routing their investments through these kind of tax havens, and this is very popularly referred using a term called treaty shopping. And then what is round tripping? Round tripping is simply, okay, many times when we ended up booking a flight ticket, you might have come across this case, isn't it? So round tripping does mean the money that leaves a particular shore. Let's say there are some people who make some black money in this country and they happen to take this money outside this particular country and simply route that particular investment back to our own country in the form of legitimate form of investment. So whatever the black money that leaves the shores of this country comes back from a tax haven in the form of a legitimate source of investment. In such case, such practice is generally what we call as a treaty shopping. So in this part of taxation, we have discussed about the meaning of tax, the difference between direct and indirect taxes, and then we understood how is cess and 𝗧 are different from taxes and the different terms related to taxation. And then we have discussed about the problems related to indirect taxation, the rationality behind the tax, VAT and GST, okay, and what exactly is the problem behind what exactly is the meaning of the problem, that's cascading effect of taxes, and then lack of common market. Then we discussed about the terms related to tax haven, treaty shopping and round tripping. And let me conclude the session with respect to 2-3 important problems related to direct taxes. The problems, though Indian government has come up with an initiative to reform this direct taxes through direct tax code bill, okay, but unfortunately not successfully bringing major changes with respect to direct taxes. But the very common problems related to direct taxes are, why is the size of black economy in India? Generally people anticipate the size of black economy or the black market transaction in this country sums up to roughly around 40 to 45% of GDP. Why in India these kind of transactions, why is the tax evasion in countries like India is very high? Is simple. The average tax rates in India is pretty much high than compared to the neighboring countries. So when the tax rates are high, definitely people tend to avoid payment of taxes. That's one major problem. Okay, and the second is simply most of the time the people are not happy with what exactly or how exactly the money is spent by the governments. Okay, so if you happen to look at, there's been a lot of criticism, okay, because of the freebies the government ends up spending it just for the sake of becoming popular. So that could be one reason, isn't it? So henceforth, and this you don't know practice, isn't it? Majority of the times there hardly any person you might have come across has been seriously penalized or simply been convicted by the courts of law, and there's hardly any stringent punishment for people to for those people who happen to evade payment of taxes, isn't it? And that's the basic reason. The practice of simply evading payment of taxes is pretty much normal in this country. And though Government of India has taken some significant steps, but it requires still some major reforms related to direct taxes. The way it happens, bring in some reforms related to indirect taxes. So this completes the part of taxation, and we'll start with a new topic, that's money and banking, in the next session. Thank you.